Right now, the public market is looking at one of the most recognizable digital labor platforms on earth and pricing it as if it's already dead. The company is Fiverr. And today, we're going to look at the exact numbers that make this such a fascinating, high-stakes story. This is a business that fundamentally changed how freelance work is bought and sold across the globe. Yet today, investors are fleeing as if the entire operational model is about to evaporate. The central tension we're unpacking here is the massive, undeniable disconnect between the cash Fiverr actually holds today and the market's complete lack of faith in its future. To understand the sheer scale of this market pessimism, you just have to look at the math. Fiverr currently has a market capitalization of roughly $331 million. But when you examine their balance sheet, they're sitting on a massive cushion of $308.5 million in cash, bank deposits, and marketable securities, with zero long-term financial debt. That means if you strip out the cash, Fiverr is trading at an astonishingly distressed enterprise value of just $28 million. You have to contextualize what that actually means. We're talking about a platform that commands millions of buyers and sellers, moves vast amounts of human capital across borders, and generated over $360 million in revenue in 2023. An enterprise value of $28 million isn't just a discount. It's the market screaming that it believes this business is in a terminal, irreversible decline. So the central question we have to answer today is this. Is this company a terminal value trap facing secular liquidation? Or is it a deeply discounted turnaround play with the fortress balance sheet required to survive? The market's ultimate fear is that generative AI is structurally replacing the total addressable market of the entry-level digital gig economy. For years, Fiverr enjoyed a powerful moat built entirely around discovery and transaction friction. Standard tasks that used to require a $50 human freelancer, like translating a document, writing a basic SEO blog post, generating a voiceover, or writing simple HTML code, relied on Fiverr to connect the buyer and seller. But that moat, it's breaking instantly. Today, those exact same deliverables can be generated virtually for free, with zero marginal cost and zero wait time, using large language models. To understand why the market is panicking so hard, we first have to understand how Fiverr actually makes its money. It all comes down to their pioneering service as a product model. Historically, if you wanted to hire a freelancer, the friction was immense. You had to write a job description, evaluate dozens of proposals, and negotiate an hourly rate. Fiverr changed all of that by packaging digital tasks into structured fixed-price listings called gigs, with automated e-commerce-style checkouts. This friction-free model was highly addictive for small businesses and allowed Fiverr to command an industry-leading marketplace take rate of 28%. When you compare that to traditional staffing agencies or even competing gig platforms that take anywhere from 10% to 15%, keeping 28% of the transaction volume is absolutely staggering. Add to that the fact that 40% of their revenue now comes from high-margin services like advertising, seller subscriptions, and their recent acquisition of AutoDS for dropshipping automation. It's a massive profit engine. But it's exactly what AI is threatening today. And this illustrates the company's desperate race against time. They're trying to pivot away from their legacy, easily automated $5 tasks, toward premium enterprise clients using Fiverr Pro. This upmarket pivot focuses on complex projects over $1,000, utilizing vetted, elite talent and integrating their own AI-native matching systems to reduce search mismatch rates. But the tension here is profound, and the switching costs are brutal. Upwork already owns the enterprise and complex project space. They're deeply entrenched in corporate workflows. Meanwhile, the Fiverr brand has a legacy association with cheap, commoditized work. The friction of convincing a Fortune 500 company to migrate their complex, thousands of dollars a month freelance budgets to a platform historically known for $5 logo designs is a massive psychological and operational hurdle. Let's look at the hard evidence from their Q2 2026 earnings reported on Wednesday, July 29, 2026. This report was a watershed moment that validated the market's darkest fears and caused the stock to plummet 20.5% in a single trading session, dropping from $11.59 to close at $9.21 on massive, panic-driven volume. The financials show a sharp, structural deterioration in transaction volume, officially missing Wall Street analyst expectations. Total revenue fell 10% year-over-year to $97.78 million. Even more concerning, active buyers contracted by nearly 14%, down to 3.10 million. When you drill into the internal segments, the rot is highly concentrated in specific categories. Translation, basic copywriting, and introductory graphic design are bleeding out fast. High-velocity, low-cost buyers are leaving the platform because they're handling those tasks in-house with AI. However, there is one beacon of hope keeping the turnaround thesis alive. Their upmarket push successfully drove spend per buyer up by 13.25% to $342. This proves that while they are losing the low-end transactions, the enterprise clients who remain are spending significantly more on complex projects. Despite that silver lining, the overall velocity of the platform is slowing down dramatically. Before this print, analysts were expecting Fiverr to maintain relative stability through the year. Instead, management was forced to slash full-year 2026 revenue guidance to a range of $356 million to $372 million, which implies a painful 14% to 17% year-over-year decline. They also gutted their adjusted EBITDA guidance down to just $52 to $62 million. The reaction from Wall Street was brutal. Analysts from Goldman Sachs, Oppenheimer, and Scotiabank aggressively downgraded the stock and cut their price targets by up to 50%, citing extremely low visibility into normalized margins and a complete lack of confidence in the short-term floor. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. The management team didn't try to hide from the reality. CEO Michael Kaufman explicitly stated during the earnings call that pressure from large language model adoption noticeably increased intra-quarter. He directly admitted that AI substitution is hurting their core transactional categories at an accelerating rate. More importantly, management conceded that this highly complex turnaround will take at least another 6 quarters to stabilize. You have to pause and think about the tension there. They are officially in a painful multi-year transition phase, trying to re-engineer their entire business model over the next 18 months, while the artificial intelligence technology they are fighting against is advancing exponentially by the month. When we synthesize all of his research into a qualitative framework, we get a blended score of 5.2 out of 10, revealing a very fragile business profile. What's really interesting here is the extreme contrast at the heart of the company. Their financial health is stellar, scoring an 8 out of 10. In late 2025, management executed an absolute masterstroke of capital allocation. They aggressively used their cash flow to completely pay off $460 million in convertible notes. If they hadn't made that specific financial maneuver, with revenue shrinking the way it is today, the company might already be facing a liquidity crisis or bankruptcy. Instead, they're left with zero long-term debt and $308.5 million in liquidity. They effectively bought themselves survival. But their fundamental business viability scores a deeply concerning 4 out of 10, purely because that legacy transactional engine is existentially threatened by AI. Looking deeper at how these metrics synthesize, management alignment is decent at 7 out of 10, with founder and CEO Michael Kaufman owning over 7% of shares, keeping his interests tied to pulling off this turnaround. Revenue quality scores a 5 out of 10. It's supported by a massive 68% repeat buyer rate and that stellar 28% take rate. A 68% repeat buyer rate shows immense loyalty among the current user base, but you have to connect the dots to the growth outlook, which is sitting at a dismal 3 out of 10. If your top-of-funnel customer acquisition is being destroyed by AI, that 68% repeat buyer base is simply a melting ice cube. You have high-quality revenue, but a shrinking pool of it. All of the research behind this video was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free, at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. This brings us to a hypothetical framework for thinking about possible outcomes over the next 5 years. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios, but we need a mathematical way to understand what has to happen operationally to justify different valuations by the end of fiscal year 2031. We're modeling 3 distinct paths from the baseline share price of $9.18. Historically, in the tech sector, when platforms face a massive technological paradigm shift, transitions like our base case are incredibly rare. Usually, outcomes are binary. Companies either successfully jump the S-curve, which is our high case, where Fiverr sheds its cheap gig reputation and becomes a premium AI-enabled talent network, or they die, which is our low case, terminal collapse. Let's map exactly what has to happen under the hood for all 3. Looking at the detailed assumptions, the logic of these multiples builds out like this. In the low case, generative AI continues to hollow out freelance categories unchecked. Active buyers collapse to 1.5 million, and revenue shrinks to $281.6 million by year 5. Margins get crushed to 2%, yielding an EPS of just $0.15. Here, the market values Fiverr exactly as what it is, a melting cash pile. Applying a distressed 5x multiple drops the share price to $0.75, an annualized loss of nearly 40%. In the base case, the bleeding stops. Active buyers bottom out at 2.2 million. Spend per buyer steadily increases to $450 as Fiverr Pro gains some traction. Revenue scales modestly to $422 million with an 8% net margin and an EPS of $0.99. Applying a conservative 10x multiple, pricing it as a sluggish, low-growth value stock gives us a $9.90 share price, which is basically flat from today. But look at the high case. If Fiverr Pro aggressively steals market share from Upwork and they successfully integrate AI prompt engineering as a massive revenue contributor, active buyers stabilize at 3 million and spend per buyer surges to $550. Revenue hits $510.5 million. Operating leverage pushes net margins to 12% for an EPS of $1.98. The psychological re-rating here is key. If Wall Street begins to view Fiverr not as an AI victim, but as an AI productivity beneficiary, they'll command a premium SaaS multiple. Applying an 18x multiple launches the stock to $35.64, over a 280% total return. When we probability weight these outcomes, giving the sluggish base case a 50% likelihood, the high case 20%, and the low case 30%, we arrive at an implied future share price of $12.31. That represents about a 34% total return potential from current distress levels. The math shows there is moderate upside, but it is heavily weighed down by the fact that Fiverr's management has to execute this turnaround flawlessly over a very narrow 18-month window. But you cannot invest based on a spreadsheet without understanding the massive threat vectors that could break this thesis entirely. The path to that $12 target is littered with existential landmines. The biggest risks start with macroeconomic customer demand. Roughly 49% of Fiverr's revenue is tied directly to small and medium businesses in North America. When interest rates remain high and inflation bites, SMBs are the very first to freeze their variable freelance budgets. Then you have competitive pricing pressure. Remember that massive 28% take rate? Emerging decentralized Web3 talent networks like Braintrust are utilizing tokenized incentives to completely slash their take rates to between 10% and 20%. Because of Fiverr's corporate overhead and margin requirements, it's mathematically impossible for them to match those low fees without destroying their EBITDA. If corporate clients demand lower fees, Fiverr's unit economics will fracture. But the ultimate terminal threat is the complete substitution of human labor by fully autonomous agentic AI systems. If a future AI agent can build a website, write the copy, and design the logo without a human intermediary, the human-to-business talent marketplace becomes completely obsolete. Because these risks are so structural, you have to watch the operational data like a hawk. The critical early warning metric investors must watch is spend per buyer. Right now, it's sitting at $342 and growing. It's the canary in the coal mine. It is the ultimate proxy for the success or failure of the Fiverr Pro pivot. If this number stalls or drops below $350 in the coming quarters, while active buyers are also shrinking, this cyclical turnaround thesis is dead. It means the enterprise clients aren't adopting the platform, and the risks have officially morphed into terminal ones. Ultimately, Fiverr's $28 million enterprise value perfectly prices in this existential race. They have a pristine, debt-free fortress balance sheet that gives them the runway to survive. But they're fighting against an unprecedented technological paradigm shift that is eating their legacy business alive. The question isn't whether Fiverr can adapt. The question is whether they can adapt fast enough to outrun AI substitution. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.